Hi everybody, welcome to the Shock Factor series video 11. And again, in this video, we shall be looking at the 11th hurdle in trying to apply technical analysis to the markets or in the markets. Again, this is Shock Factor video number 11. So without further ado, let us now press on with the rest of the slides. Okay, let us ask ourselves two very important questions. It might sound superficial to some of you, but trust me, these questions are probably some of the most important questions you have to ask yourself before you delve or engage with the markets with real capital. These are the important questions to ask. You will find out in a short while why I'm saying this, okay? Why these are some of the most important questions that you must ask yourself before you start trading real money. Of course, if you're just trading demos all your life or virtual accounts, then maybe it doesn't really matter anyway. Okay, so first question we have to ask ourselves is, what is a safe percent capital exposure to risk per trade? So for every trade, for every position you open, what is a safe or reasonable percent capital exposure that you need to place or inject into the markets for a commensurate return? So therefore, should we risk 0.01% of our capital per trade, or maybe 0.1%, 0.5%, 1, 2, maybe even higher? What is the optimum? The question is, what is the optimum percent capital exposure that we should place per position or per open position in the market? Okay, what is the optimum percent risk per capital? Okay, in order to ensure long-term trader survivability, and again, ensuring that we are not over trading or under trading. We want to trade at the optimum percentage capital exposure level. Okay, so this is a very important question. Now, if you risk too little, you're under trading. If you risk too much, you're over trading. So whenever we come to money management and risk controls, we never, ever ask the question, what's the maximum I can risk? That is the wrong question. Neither should you ask, what is the minimum I should risk? Although asking what the minimum is still a better option than asking what the maximum is, the best way to go forward is to ask yourself, what is the optimum percent capital exposure that makes the most sense in terms of risk control and money management and long-term trader survivability going forward? It might seem like a superficial, a very simple question, but trust me, as I said earlier, probably one of the most important questions you can ever ask before risking your hard-earned savings, and also your future children's inheritance. This is where most traders make the biggest mistakes. Now, having said that, this leads us to the next question. This is per trade, per position, per open position. But what if we have multiple open positions? What would then be a safe total overall percent capital exposure of all positions combined? This is a more serious question. But assuming that you only have one open position at any one time, then only question 1 is relevant. But if you're opening multiple trades, then question 2 comes into play, seriously comes into play. This will then represent a more serious question as compared to question 1. So question 1 is relevant only if you're trading only one position, one open position per any one instant in time. But if you're trading multiple positions, you have multiple open positions, this is the more critical question to ask, because your percent exposure will be much higher. Okay, so let us press on with the rest of the slide and let me help you understand why these are some of the most important questions. But before that, I just want to qualify something. These questions, these two questions that you see in front of you, this only so far, before going on to the next slide, only applies to normal everyday scenarios or normal everyday trading situations. Okay, that's all. As long as everything moves normally in a familiar, recognizable, consistent manner or fairly consistent manner, these questions can be addressed quite simply, quite easily. You can quite easily answer these questions. Okay? Although it's not that simple, but at least you can come to some conclusion. But I'm not talking about this. In this video, I'm talking about the shock factor. So we're not talking about normal, everyday situations anymore. I'm talking about events or those days or those times when an outlier event occurs, when market shocks occurs, when tremendous market shocks occurs and you suffer from the extreme volatility. And when I mean extreme volatility, I mean the inability for your trading platform to cope, to execute your orders efficiently or effectively. But again, to bring some light as to what I'm trying to refer to, let's press on to the next slide. So let's look at negative slippage. This is a killer. This is a killer. But under normal, everyday, okay, let me say this again. Let me qualify the statement. But under normal, everyday situation, it is not too bad. It won't affect you that badly. But to reach the shock level or the shockingness degree level, we need to look at weekend gaps and unexpected economic release results. The keyword is unexpected. Okay, and the other are some weekend gaps that we need to look at. So therefore, this video is all about negative slippage in the worst possible sense of the word. I'm looking at extreme scenarios. These are not that extreme yet. Weekend gaps and unexpected economic release results. These are not too extreme. There's a second scenario where we look at outlier events, the black swan events. And I'm going to show you one example of that. So therefore, so this is the key sentence. This is the key statement I'm making now. Although when we trade and we try to figure out what is the optimum percent exposure per trade, and if you're trading multiple open positions, what is the total percent capital exposure that you should have, which you should not exceed. Under normal everyday trading situations, that is not too hard to derive. You don't want to overtrade, neither do you want to undertrade too much, okay? I'm not talking about these normal everyday situations. You can carry on doing all this if you want, with whatever you believe is the optimum percent capital exposure. But I'm talking about the shocking events, the events that goes beyond the normal everyday trading scenarios. Let's go to the first example. So I'm now going to look at typical, but a little bit extreme, a little bit more on the extreme side. Typical weekend gaps and certain unexpected economic release results. How do they impact your trading performance in terms of the percent risk that you may be exposed to? Okay, let me show you. Let's press on to the next slide. Okay, so let us look at some simple scenarios. It is these scenarios that are going to, these different instances that I'm going to present to you, they are not too far from reality. They're pretty close, because I'm not talking about normal slippage, the normal everyday slippage. I'm not talking about that. I'm talking about this kind of thing here. You know, something a little bit more out of the ordinary, okay? Like weekend gaps, and not normal weekend gaps. I'm talking about those weekend gaps that are just a little bit more aggressive, okay, a little bit more menacing, okay? And those economic release results that are a little bit more unexpected than normal, which will cause great volatility. Because, you know, the market is shocked, the market is trying to adapt to the unexpected result releases and so on. And certain weekend gaps that occur, they are a little bit more aggressive than normal. I'm talking about those situations, not the usual weekend gaps of maybe 10 pips, 15 pips and all. No, I'm talking about the ones that are a little bit more significant. So let's press on with this slide here. Again, this is a simple illustration of a few different scenarios based on a few different parameter values. So here again, let's assume we have a simple setup. Okay, we want to go long. Let's assume in all these examples we want to go long. We have a stop loss below it to cap our losses, for example. Now, first thing I want to mention is that if you go back to your fundamentals, the basic stuff, you would already have known that a stop loss is a form of a market order. Now, unlike a limit order, it is totally diametrically opposed to each other. So a stop loss is a form of a market order. And what is a market order? Well, I'll give you the simple version. A market order is an order that you place in the market, especially a stop loss, for example. But it can be anything. It can be a buy stop order, or a sell stop order, or whatever. Any order with the word stop is also a market order. Any market order has this characteristic. Very simple. It will guarantee you execution. That means if you have a stop loss and price hits the stop loss, you're guaranteed to exit the market. The stop loss will be executed perfectly. You'll be guaranteed to exit. But the problem is that there's no guarantee as to the price of exit, but there is guarantee of execution. So if prices falls and hits the stop loss or penetrates it, you're guaranteed that you will be exited from the market. Guaranteed. But it is not guaranteed as to at which price level you'll be exited. That is the problem. Unlike a limit order, which is the opposite from a market order. A limit order, you'll be guaranteed. It's actually the total opposite. You'll be guaranteed to exit at your price level, or even better than that. But there's no guarantee you will exit. That's the problem. As you can see, there are two diametrically opposed mechanisms, totally opposite of each other. So again, because of the nature of a market order, and in this case, it is represented here by a stop loss, the market can slip right through it. In case of a very volatile market, the market prices can slip right through this. Yet, although you're guaranteed execution, but you're not guaranteed at what price or at the price that you intend to exit. So therefore, the market can slip all the way down. Let's say over 120 pips. And at that point, the stop loss gets triggered and you're out the market. Although you intend to exit 40 pips below your entry, but because it's a market order and the market was extremely volatile and it fell over 120 pips before your stop loss was triggered and you were exited from the market. Can you see that? Although this was your intended risk by entering this position, the eventual risk was actually 120 pip loss instead of a 40 pip loss. And let's assume that you risked 0.1% of your capital across 40 pips. So if your total slippage was 120, which is 3 times this amount, that means your total loss, once your stop loss gets filled at this point here, and you're out the market, instead of losing 0.1%, you lose 3 times that amount. 120 is 3 times the multiple of 40 pips, so you lose 0.3%. Although originally you only intended to lose 0.1%, now you lose 0.3 by nature of the stop loss being a market order and slippage, negative slippage occurs. Okay? That means slippage that is disadvantageous to you, unfavorable to you. So again, 120 pip slippage is not unusual, especially in the currency markets. It's not unusual. I've seen it many times over. But again, I'm not talking about normal slippage. Let me remind you, not the every weekend slippage, the usual ordinary stuff. No, I'm talking about those situations where it is a little bit more extraordinary, a little bit more aggressive than normal. Maybe something occurred over the weekend, some news came out, very negative news, and that particular currency reacted very, very negatively towards whatever news that was. It could be geopolitical or whatever. Okay? Let's assume that the weekend gap or the economic release resulted in a slippage that is even more aggressive. Okay? Even more substantial. Okay? Let's assume it's 240 pips. Now, again, our stop loss is 40 pips. We reach 0.1%. Now, you lose much more, 0.6% of your total capital, for a slippage of 240 pips. If it's 360, you lose 0.9%. If it's 600 pips, I've seen it before. Let me reassure you. I've seen this before, especially in the pound yen and a few other cross currencies, especially in the cross currencies. Okay? Not the standard pairs so much, But yes, it occurs as well. But in the cross currencies, especially by way of its mathematical structure. Okay, as you will see in the upcoming shock videos, I'll explain why that is the case. Not in this video, but in a subsequent video or videos. So I've seen this before. A weekend gap of 600 pips. And obviously, if it's a weekend gap, it's going to be slippage for sure, because there's no trading within that range of prices. It only occurs 600 pips below. The next buy-sell order only occurs here. So therefore, I've seen this before. This is not uncommon. Let me reassure you. Yeah. So again, you're doing your job. You're just risking 0.1%. Yeah, very small amount. Seems to be quite all right. And in normal circumstances, in normal everyday circumstances, this is quite okay. 0.1 for me, it's a little bit high, but it's okay. It's okay. Not too bad if you're careful and your frequency of trades is not too high. Okay, not like you're doing 100 trades a day or something. If you're doing that, then 0.1 is way too high. It's way too high for 100 trades a day. Okay, if you're doing only one trade a day or every 2 days, 1 or 2 trades, 3 trades, yeah, it's okay. It's all right. It also depends your percent risk, your percent capital risk exposure also depends on the frequency of trades, and that determines whether it's reasonable, or unreasonable, whether it's a high risk venture or whether it's something that is quite acceptable. And you're able to control your overall system risk, okay? It depends on the frequency of trades as well, yes. That's why, for example, if you only trade once a month and you're an investor, you're not a speculator, you only trade once a month, you buy one share a month, one stock a month, or buy extra shares every month. Yeah, that's okay. Your frequency is very low. You can risk more, much more than 0.1. You can risk 2, 3, 4, 5, 6% of your disposable capital. But in speculative trading, it's completely the opposite. You can't pursue trading with that kind of level of risk. You can't do it. Imagine if you risk 5% per trade and you have 100 trades a day. Honestly, think about it. There is a possibility, if we exercise seeing everything from the worst case scenario perspective, there's a chance you can blow up your account in just one day. And if your account is about, say, a 500,000 US dollar account, are you willing to blow up your 500,000 US dollar account in one day? Honestly, if you risk 0.1% based on your everyday usual trading scenario situations, that's okay. But sometimes you have this kind of events, some aggressive, volatile market shocks that occur, and there's a gap. For example, let's just call this weekend gaps, okay? And as the gaps gets larger and larger, due to the severity of the news being released or whatever geopolitical event that's occurring, these are the kind of losses you expect. Now, these losses here are not earth-shattering. You can easily come back from a 0.3% loss, 0.6, even or 1.5. Yeah, you can easily come back from that. It is not account threatening or in any way. You can easily recover from this. But let's bump this up a bit. Let's say on an everyday basis, you trade 0.5% per trade. You risk 0.5% of your capital per trade. Let's assume the same 40 pips, just to keep everything nice and normal and everything on being equal and all that, so that we have a very clear sense of comparison and contrast. So if you bump it up to 0.5, everything based on the earlier slide, this one, which is 0.1, now we move everything up to 0.5 per trade. We multiply all our losses by 5 times the multiple. Okay. So again, based on the same slippage or weekend gap, same negative slippage or weekend gaps, they both represent the same thing. Same kind of you get the same kind of results. Your loss is now 1.5% for 120 pip. Gap or slippage is 3% for 240 pip. Gap or slippage for 360 pips is 4.5, and for a 600 pip, which is not uncommon, let me reassure you again, this is the second time I'm saying it, you suffer 7.5% loss of your capital in just one move. From last week's closing to Monday morning opening, you lose 7.5%. Right there and then, and that's it. It is what it is. This is quite a significant loss. You may be able to come back. Yes, it's not impossible, but it's a lot of work to recover. Because don't forget, if you trade on a reward to risk ratio of 1-to-1 or even 2-to-1, each time you make a profit or each time you realize your reward, you make only 0.5 to 1%. If this is a 1-to-1 for 40 pip, this should be 40 pip. You make only 0.5%. If it's 2-to-1, you make 1%. Now, if you lose 7.5% and you have a 1-to-1 reward to risk ratio, do you know how many times you have to trade just to recover this loss? Each time you only make 0.5, but this is 7.5. Okay, now let us bump it up a little bit more to 1%. Okay, sorry, 1%. So we started with 0.1, and these were our losses in the event of this kind of aggressive slippage or weekend gaps occurring. Then we went up to 0.5, everything went up 5 times the amount. Now let's go up to 1% per trade. For each trade, let's assume each trade you risk 1% of your capital. For 120 pips slippage or weekend gap, you lose 3% of your capital. For 240, you lose 6. For 360 pips, you lose 9. And for something that is not uncommon, 600, especially in the cross pairs, as I said before, you lose 15% of your capital. A lot of traders believe that 1% is quite reasonable for an everyday normal situation trade per position, per entry. Okay, 1% is quite realistic, quite normal. It's not excessive. That's what they think. But don't forget, when these kind of situations occur, when you have gaps and tremendous negative slippage, the losses you suffer in that one trade, assuming that you're not even doing multiple trades, you don't have even multiple open positions at any one time, you only have one position. But if you are in this situation, things go sideways very fast. Whatever risk you have here could be multiple times the amount that you could never even imagine could occur. Okay, so let me go back to this one, 1%. As you can see, if this occurs in the cross pairs, especially in the cross pairs, during an aggressive weekend gap or negative slippage event, you can lose up to 15% of your capital. But let's assume that you have a 1-to-1 reward to risk ratio, okay? And let's say it's not that consistent. You're just breaking even and all that. And each time you risk 1% to make 1%. If in just one trade over the weekend, over an unexpected economic release, and the market is extremely volatile, or at least fairly volatile, and you lose 15% in one trade, if you have multiple trades open, all having the same directional characteristic, you're going to be in big trouble. If you have 5 or 6 trades open, that's the end of your account. You have obliterated your account. That's it, assuming they all have the same directional characteristic. Now, let's bump it up a little bit more to 2%. Now, this is where it gets very seriously shocking and scary. For 120 pips slippage or weekend gap, you lose 6%. Not too bad. Okay, but for 240, you lose 12%. 360, you lose 18%. And for 600, normally in the cross pairs, you can lose up to 30% per trade. If you have 3 or 4 trades open with the same directionality characteristics, you are in trouble. You're in big trouble. Okay? All right? You better pray that it gaps in the other direction. So let me go back to the first slide, 0.1%. This, on a normal everyday basis, based on all the trades that you're doing, okay, it seems not too bad. A little bit high for me, still a bit high for me. I'd rather go a bit lower than 0.1%, but let's assume that, that's okay. Not too ridiculous. Okay? But that's only for normal everyday trading in the complete absence of any kind of volatility or gap or serious weekend gaps or very significant economic release results that are like totally out of whack, totally unexpected. Okay? Now, that can cause this kind of weekend gaps or this kind of negative slippage during the economic release. Up to this amount. I've seen this. It's not uncommon in the currency markets. Here I'm referring specifically to the currency markets. Okay? So you can see 0.1, not too bad. You can come back from there. 0.5, a little bit more demanding on your trading system. 1% can be quite damaging. 2% is devastating. To come back from even 12, 18, 30 is a tough job. It is a tough job, especially when you suffer these losses in just one trade. And if you have multiple positions open at the same time, all having the same directional bias, now you're in big trouble. The percentage risk, this is critical. Just because on an everyday basis, it's okay. It seems reasonable. But you still have to account for those events where the gaps or the negative slippage is a little bit out of the ordinary. Sometimes it's not as damaging. A lot of times it's a little bit more damaging. But it occurs. And you have to ask yourself the $64 million question. If this occurs, how do I come back? So now you have to go back, reverse engineer, reassess, and ask yourself, is this too high a risk? Because you have to account for these events occurring as well. And if you go up to 1%, it is going to be quite devastating to your account. 2%, there may be a possibility that you won't be able to recover from this, especially if you have 2 or more positions open. They are also long and suffering the same slippage in a very highly correlated currency. You see what I mean? Or maybe in the same currency. You have to be very careful. So don't just think about what's in front of you. Don't think short term. Don't just focus on the things right in close proximity to where you are, in terms of time or in terms of distance or in terms of what other dimensions. Think beyond that. Always ask the most important question in trading. And that question is, what if? What if this happens? What if this happens? I know it's not a common event, it's a rare event, but what if? Will I able to come back? Will I able to survive and come back and fight another day? Will I able to live another day and come back and be able to recover my account? The what if question is the most important question in trading. You have to anticipate and try to see what you can do and try to account for it. Find a way to address it, to account for it if it occurs. And if you have not thought about this, my recommendation is stop trading, because I can promise you this kind of events will occur from time to time. And if it so happens that you're in the market at that time, you're going to be in big trouble. Okay, let's press on now. Okay, let's go to more serious events. Now I'm elevating to the next level, okay? I'm escalating the sense of devastation to the next level. I'm going to focus on shocking negative slippage and serious shocking gapping events and scenarios. So now let's look at what normally a lot of people refer to as the outlier events. The events that occur only once in a very long time, seriously damaging. A lot of people refer to as the black swan events, okay? Now, having said that, let's go. So now, well, I just want to bring your attention to one particular event that occurred 10 years ago on January the 15th. I was there. I was in the markets. I was looking at it. I was seeing this happen before my very eyes. And I can never forget that event, honestly. But I was not in the market. Thank God for that. So anyway, on January 15th, the Euro-Swiss franc, it crashed because the Swiss National Bank removed the floor and all that stuff, okay? I mean, you can go check this on the internet. And the market fell instantly, within minutes, to around 4,000, plus or minus approximately 4,800 pips. Market just shot all the way down, okay? It just went. bang, all the way down. Super fast. Ridiculous. I've never seen anything like this in my entire life. But it happens. So this is an outlier event, a black swan, once in a while. Can it happen again? Yes, it can, of course, obviously. In these examples, I'm referring to slippage or gapping occurring in an outlier event, in a black swan event. So let's talk about much larger slippage or gapping situations. Let's say 800 pips. Let's start with 0.1 again. You lose 2% of your cash. Not too bad. You can come back from that. If the slippage or the gap is 1,000 pips, 2.5% loss, yes, you can come back from that. 4%, 1,600 pips, yes. This particular scenario, this represents this, for example. Let's take this into account, or let's focus on that. That's a plus or minus around approximately 4,800 pips. This is quite damaging, but okay, 12% you can survive. There's a possibility that you can work hard, and because each time you make money on a one-to-one, you only make 0.1%, but to come back from 12%, you can calculate yourself how many trades that take. In the absence of a horrendous win-loss distribution impacting your system, you can imagine how long it takes you to come back with this setup. From that perspective, it is extremely damaging. Yes, that's right. In just one trade, in just one open position, what if you have multiple open positions? Then what? You see, that's the problem here. Okay, now let's bump it up to 0.5% and see what happens. Based on an everyday trading percent capital risk kind of scenario, not accounting for this kind of events that may occur at any time. So let's assume that now you bump it up to 0.5, 800 pip slippage or gap will give you a 10% loss. 1,000 pips will be 12.5, 1,600 will be 20%. And well, assuming you have that Euro Swiss franc event and you suffer the worst case scenario, you lose 60% of your capital in just one trade. But on an everyday basis, 0.5 seems to be not too bad. But it is too high for me. I'm sorry. Personally speaking, this is too high. 0.5 is, for me, is just eventual financial suicide. That's all. Might as well just give it to charity. It's better that way. Unless it's all totally disposable capital that you're risking and you don't mind losing all of it. That's fine. In that case, that's your choice. If that event that I mentioned occurred, you will lose 60% in one trade. That's only with one position open. If you have 2 or 3, well, that's the end of your account. Let's bump it up to 1%. At 800 pips, you lose 20%. Each time you only make one. Might seem, in a sense, there's some degree of recoverability, of recoupability of whatever you lost. Maybe you can work hard on that. With the 1,000 pip loss, 25% of your capital gone in just one trade. With 1,006, you lose 40%. And with the event that I mentioned, the Euro Swiss franc event, you lose, well, there goes your account. You lose more than 120%. Okay, so now let's move on to the next slide, the final slide. Let's assume that on an everyday basis, you're trading at 2% per trade on an everyday basis. With this kind of event occurring, an outlier or black swan event, with a 2% risk per trade, with an 800 pip slippage, you lose 40%. This is devastating. Okay, with 1,000 pips, just 200 pips more, you lose half your amount. You lose half your capital in your account. With 1,006, you lose 80. And with that event, the Euro Swiss franc, if that occurred while you were trading, and it may occur one day again in the future, hopefully not. I'm not hoping for that, but it might be a lesser amount, 2,400 pips, or maybe 1,500 pips. I don't know, something like that. You still lose 80%. If you were trading with a full service broker, you're in big trouble. So going back again, let's go back to our earlier slide. This represents the 11th shocking hurdle in trying to apply technical analysis in the market. And again, let me qualify this statement. Not only technical analysis, any kind of analysis. Whether you're using technical analysis, whether you're not using technical analysis, it doesn't matter. Everyone suffers the same outcome in extraordinary events like this. Tremendous slippage or tremendous gapping. You see that? So to summarize, what I'm trying to convey here is that although on an everyday basis, You trade with 0.1. Some people say, some traders say, okay, 0.5 is good. Some say, 1% is still not too bad. Some even say 2% is normal. It's just an average amount of risk to put into the market. Yeah, they could be right. It also depends on how much capital you're risking. If you're only risking 500 US, who cares? If you're risking 5 million US, yes, you better pay attention. Because to lose 12% in one day based on your $5 million account, I mean, honestly, are you able to withstand that kind of roller coaster ride? Emotionally, physically, psychologically, mentally, maybe even spiritually. Are you able to handle it? In one day, you lose 18% of your $5 million account, or your $10 million account, or even your $500,000 account. Are you able to do that in one trade? Assuming you only have one position. You're lucky enough to only have one position open when this event occurs. You have to think carefully. Okay? So what is the best way forward? All I can say is this for now, because this video is only a YouTube video. It's not a masterclass or anything. I have that be coming in the future after I've done enough videos. Okay, I will offer that later on. Okay, so just hang on. I need to awaken everybody first. So the general rule for now, just to give you a bandage to cover your wound, if you're suffering. I hope you're not. The smaller the risk, the safer you are. The sacrifice you make is that on a daily basis you earn less. But the great advantage you have is that you can sleep at night. Even with the worst slippage or the worst outlier or black swan event, you can still sleep at night. You still have a degree of recuperability of whatever drawdown you have that you suffered or experienced in that single trade. There is a compromise that you have to make. You earn less on a daily basis, but you are very well protected against tremendous black swan events. Or you earn more on a daily basis. You earn more on a daily basis. 1% instead of 0.1. You earn 10 times the amount. But now you are less protected in the event of a black swan or outlier event or a tremendous weekend gap. You have to balance between your everyday risks that you want to take and account for the black swan events if it occurs. And I can guarantee it will occur once in a while. And if you go back to short video 2 or 3 or some, I can't remember, it's one of those, you see that if you lose a large amount in the beginning, it takes you almost forever to come back. Let's assume that your system works perfectly. Let's say every window of 10 trades, you make a consistent amount of returns. But that will never happen in reality because of the win-loss distribution, which you cannot control. As I said before, you can control how much you win when you win. When you have a profitable trade, by virtue of placing your take profit at a certain distance. And you can control how much you lose by virtue of placing your stop loss at a certain distance. Okay? But you cannot control the number of wins and losses. And that is what I mean by the win-loss distribution affecting your trades, which is uncontrollable. Anyway, again, as I said in some of the videos, some of the earlier videos, I do not want to offend anybody. I'm not here to scare anybody, but I do want to raise the level of understanding, the degree of realization, okay, being very enlightened as to the number of ways that your account can be seriously affected. The final statement I want to make, always ask yourself, what if? All right. Thank you so much again for spending time watching my videos. I hope you gained something from all this. Again, I thank you for watching this video, and I'll see you in the next video very shortly. But until then, as usual, take care, be safe, and bye-bye.